Look, I need to show you something that's happening in the gold market right now that most people are completely missing. And I'm not talking about the price. I'm talking about something far more significant that's unfolding behind the scenes while everyone's distracted by the daily charts. 3 weeks ago, something extraordinary happened at the London Bullion Market Association. The LBMA, for those who don't know, is essentially the nerve center of the global gold trade. They handle more gold transactions in a single day than most people will see in a lifetime. And they just released data that should have made front-page news everywhere, but it barely got a mention. The amount of physical gold being withdrawn from LBMA vaults hit levels we haven't seen since the 2008 financial crisis. We're talking about 287 tons in a single month. To put that in perspective, that's roughly equivalent to 3 months of global mine production just vanishing from the system. And here's what makes this absolutely critical. It's not coming back. See, there are 2 types of gold movements in these vaults. There's the normal shuffling that happens every day as banks and dealers move metal around for various reasons. That's just business as usual. But then there's what we're seeing now, which is permanent withdrawal, gold leaving the system entirely. And when I started digging into where it's going, that's when this story gets really interesting. I spent the last 2 weeks talking to people in the industry, people who actually move this metal. And what they're telling me is that the destination for most of this gold is Asia. But it's not going to jewelry manufacturers or industrial users. It's going into private vaults. Wealthy families, institutions, sovereign wealth funds. They're taking delivery of physical metal, and they're putting it somewhere the Western banking system can't touch it. Now, why would they do that? Why would sophisticated investors pay the premium for physical gold, pay for secure storage, pay for insurance, when they could just hold a paper claim that's so much more convenient? Because they know something. They understand what's happening to the global monetary system, and they're positioning themselves accordingly. Let me take you back to 1971 for a moment, because there's a parallel here that's almost eerie. In the months leading up to Nixon closing the gold window, something similar was happening. Foreign central banks, particularly France under Charles de Gaulle, were converting their dollar holdings into physical gold at an accelerating rate. They were draining Fort Knox. The U.S. gold reserves were hemorrhaging, dropping from over 20,000 tons in the 1950s to barely 8,000 tons by 1971. And here's what most people don't realize. The smart money knew it was coming. There were whispers in the market, people who understood the math, who could see that the U.S. had printed far more dollars than it had gold to back them. They were quietly positioning themselves. And when Nixon made that announcement on August 15, 1971, those people were already protected. Everyone else? They woke up to find the rules had changed overnight. Fast forward to today, and we're seeing the same pattern, just on a much larger scale. The LBMA withdrawals are just one piece of it. Look at what's happening at the COMEX in New York. Registered gold, that's the gold that's actually available for delivery, has been declining steadily. We're now at levels where the paper claims on that gold exceed the physical metal by ratios that would make your head spin. I pulled the data last week. For every ounce of physical gold sitting in COMEX registered vaults, there are approximately 143 ounces worth of paper claims. Think about that. If even a small percentage of those paper holders decided they wanted actual metal, the entire system would seize up instantly. It would be like a bank run, except instead of people lining up for cash, it would be institutions demanding gold that simply doesn't exist. And this is where it gets really uncomfortable for the people running the show. Because unlike 1971, when the U.S. could just change the rules and walk away from gold, today's situation is far more complex. We've got central banks around the world that have been accumulating gold at record pace. The World Gold Council just released their Q3 data, and central banks added another 337 tons to their reserves. That's on top of the 1,037 tons they bought in 2023, which was the second highest year on record. But here's what's fascinating. It's not the usual suspects doing most of the buying. Sure, China's adding to their reserves, Russia's been accumulating for years despite sanctions. But now you've got countries like Poland, Singapore, India, Turkey, all building their gold reserves aggressively. These aren't random decisions. These are coordinated moves by countries that are looking at the global monetary system and deciding they need an insurance policy. Let me tell you about a conversation I had last month with a former central bank official. Can't name names, but this person spent decades in the system, understands how it works from the inside. and they told me something that really stuck with me. They said, "The gold market is the only market where the price doesn't reflect reality. Every other market, when demand exceeds supply, prices rise until equilibrium is restored. But in gold, we've created this elaborate system of paper derivatives that suppresses the price signal. And that can only last as long as people are willing to accept paper instead of metal." Think about what that means. The price you see on your screen, the spot price that everyone references, that's not really the price of gold. That's the price of a promise to deliver gold. And as long as most people are satisfied with the promise, the system works. But the moment people start demanding the actual metal, everything changes. And that moment? It's happening right now. That's what these LBMA withdrawals are telling us. That's what the COMEX inventory decline is signaling. That's what central bank buying is screaming at us. The smart money is moving from paper to physical, and they're doing it quietly, before everyone else figures it out. Now, I want to pause here for just a second because this is relevant to a lot of people watching this. If you're sitting on retirement accounts, IRAs, 401ks, and you've got $100,000 or more in there, you might want to understand how gold IRAs work. I put together a free guide that explains the whole process, how you can get physical gold into your retirement account without triggering tax penalties, what the rules are, what to watch out for. It's in the description below. No obligation, just information. Because what I'm about to show you next is going to make it clear why this matters. All right, so let's talk about what happens when this paper-to-physical squeeze really accelerates. We've got historical precedents, and they're not pretty for people caught on the wrong side. Go back to 1980. Gold hit $850 an ounce in January of that year. In today's dollars, adjusted for inflation, that's over $3,200. But here's what most people forget. That spike wasn't driven by investment demand or jewelry buying. It was driven by a crisis of confidence in paper currencies. The Soviet Union had just invaded Afghanistan. Inflation was running at 13%. Interest rates were heading toward 20%. And people were scrambling for real assets. But here's the thing that's different about today. In 1980, the gold market was tiny compared to the broader financial system. Today, we've got a derivatives market that's measured in the hundreds of trillions of dollars, all built on the assumption that paper claims are as good as physical metal. When that assumption breaks, and it will break, the repricing is going to be violent. I've been studying the mechanics of how this could unfold, and there are a few potential triggers that keep me up at night. The first is a sovereign default on gold obligations. Imagine if a major bullion bank, one of the institutions that's supposed to have the gold to back their paper claims, suddenly can't deliver. Maybe they've leased out the gold and can't get it back. Maybe they've sold the same bars multiple times to different clients. Whatever the reason, they default. What happens next? Well, every other institution that's playing the same game suddenly comes under scrutiny. Clients start demanding audits. They want to see their gold, touch it, verify it exists. And when you've got a system where the same gold has been hypothecated and rehypothecated multiple times, that scrutiny is fatal. The second trigger is a major geopolitical event that causes a flight to safety. We're talking about something on the scale of a Taiwan crisis, a major war in the Middle East, or a collapse of a significant currency. In that scenario, the demand for physical gold would overwhelm the system's ability to deliver. Premiums for physical metal over paper would explode. We saw a taste of this during COVID when premiums hit 10 to 15% over spot. In a real crisis, we could see premiums of 50% or more. The third trigger, and this is the one I think is most likely, is a gradual loss of confidence in the dollar's reserve status. This is already happening, just slowly. The BRICS nations are building alternative payment systems. Saudi Arabia is accepting yuan for oil. Central banks are diversifying away from dollars. Each of these moves is small on its own, but collectively, they're eroding the foundation of the current system. And here's why that matters for gold. The dollar's value is inversely correlated with gold's value. Not perfectly, but the relationship is strong. When confidence in the dollar declines, gold rises. But more importantly, when the dollar loses its reserve status, the demand for gold as an alternative reserve asset explodes. Let me give you some numbers to illustrate this. Right now, global central bank reserves are roughly $12 trillion, and about 60% of that is in dollars. If that percentage drops to 40% over the next decade, which many analysts think is conservative, We're talking about $2.4 trillion that needs to find a new home. Some of that will go into euros, yen, yuan, but a significant portion will go into gold. Now, the entire above-ground gold supply is worth roughly $15 trillion at current prices. If even 10% of that $2.4 trillion flows into gold, that's $240 billion of new demand. To put that in perspective, total annual gold mine production is worth about $200 billion. So we're talking about adding more than a year's worth of production to demand, and that's just from central banks rebalancing. That doesn't include private investors, institutions, or the paper-to-physical squeeze I mentioned earlier. What does that do to price? Well, if you believe in supply and demand, and I do, it means gold has to reprice significantly higher. How much higher? That's the trillion-dollar question. Some analysts are calling for $3,000. Others say $5,000. The more aggressive forecasts go to $10,000 or beyond. But here's what I think people are missing. The price target doesn't really matter. What matters is the purchasing power. Gold doesn't go up in value. It maintains its value while currencies lose theirs. An ounce of gold bought the same amount of goods 100 years ago as it does today. It's not that gold got more valuable. It's that the dollar got less valuable. So when we talk about gold going to $3,000 or $5,000, what we're really saying is that the dollar is going to lose more purchasing power. And if you're holding dollars or assets denominated in dollars, you're going to lose wealth. Not nominal wealth, but real wealth. The number in your account might stay the same or even go up, but what that number can buy will decline. This is why the move from paper to physical is so critical right now. Because when this repricing happens, and I believe it's inevitable, the people holding paper claims are going to discover that their claims aren't worth what they thought. There will be settlement in cash instead of metal. There will be force majeure clauses invoked. There will be legal battles that take years to resolve. Meanwhile, the people who took delivery of physical metal will have preserved their wealth. I want to show you something else that's happening that supports this thesis. Look at the gold to silver ratio. Right now it's sitting around 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. During times of financial stress, it often drops to 40 to 1 or lower. Why does this matter? Because silver is even more constrained than gold. Industrial demand for silver is massive and growing, particularly with the green energy transition. Solar panels use silver. Electric vehicles use silver. 5G infrastructure uses silver. And unlike gold, most silver gets consumed. It's used in industrial applications and never recovered. So we've got this situation where silver demand is surging, supply is tight, and the price is being held down by the same paper derivative games that suppress gold. When that breaks, and silver starts to catch up to gold, we're going to see explosive moves. I'm talking about silver potentially going to $50, $75, maybe $100 an ounce. And that's going to pull gold higher with it. Now, let me address something I know some of you are thinking. If this is so obvious, why isn't everyone doing it? Why isn't this front page news? And that's a fair question. The answer is that the system has enormous inertia. The people who benefit from the current arrangement, the big banks, the governments, they have every incentive to keep things going as long as possible. And they have the tools to do it. They can manipulate futures markets. They can coordinate central bank gold leasing to increase supply temporarily. They can use media to downplay gold and promote other assets. They can change regulations to make physical ownership more difficult or expensive. All of these things are happening, and they're effective at slowing down the transition. But here's the thing about systems built on unsustainable foundations. They can last longer than you think, but they can't last forever. And when they break fast. The Soviet Union looked stable until it didn't. Lehman Brothers was fine until it wasn't. The Swiss franc peg held until it collapsed in minutes. That's why the move to physical gold isn't about timing the market perfectly. It's about being positioned before the break happens. Because once it's obvious to everyone, it's too late. The premiums will be prohibitive. The availability will be limited. The system will be in crisis mode. I've been tracking the premiums on physical gold coins and bars, and they're already starting to creep up. American gold eagles are trading at 5 to 7% over spot. Some European mints are showing delivery delays of 6 to 8 weeks. These are early warning signs. Not flashing red yet, but definitely yellow. And then there's what's happening in the mining sector, which tells its own story. Gold mining companies are trading at valuations that make no sense if you believe gold is going higher. The average gold miner is trading at a price-to-earnings ratio of around 15, compared to 25 for the broader market. Their profit margins are expanding as gold prices rise, but their stock prices aren't reflecting it. Why? Because the market doesn't believe the gold price is sustainable. The market thinks this is a temporary spike that will reverse. But what if it's not? What if we're in the early stages of a multi-year bull market in gold? Then these mining companies are absurdly cheap. I'm not giving investment advice here, but I am saying that the disconnect between physical gold demand and market sentiment is creating opportunities. Whether that's in physical metal, mining stocks, or other gold-related assets, there are ways to position yourself for what's coming. Let me bring this back to the bigger picture, because this isn't just about gold. This is about a fundamental restructuring of the global financial system. We're living through a transition period where the post-World War II monetary order is breaking down and something new is being built. And in transition periods, the people who understand what's happening and position themselves accordingly do very well. The people who don't, who assume things will continue as they always have, they get left behind. Gold is the canary in the coal mine. It's telling us that confidence in the current system is eroding. The smart money is moving. Central banks are moving. Wealthy families are moving. The question is, are you moving? Because here's what I know from studying financial history. The people who preserve wealth through major transitions are the ones who act before it's obvious. They're the ones who look at the data, understand the trends, and make decisions based on logic rather than emotion. They don't wait for CNBC to tell them it's time to buy gold. By then, the opportunity is gone. Right now, today, you have a window. The price of gold is elevated but not parabolic. Physical metal is available but getting tighter. The system is stressed but not broken. That window won't stay open forever. And when it closes, when the paper-to-physical squeeze really accelerates, when the repricing happens, the people who waited are going to wish they hadn't. So what's the most important move for gold owners right now? It's simple. If you own paper gold, convert it to physical. If you own physical gold, make sure it's in your possession or in a vault you control, not in the banking system. If you don't own gold yet, understand that this isn't about speculation. This is about preservation. This is about making sure that when the system resets, you're on the right side of the trade. The data is clear. The trends are undeniable. The smart money is moving. The only question is whether you're going to move with them or whether you're going to wait until everyone else figures it out. Because I can tell you from experience, by the time everyone else figures it out, it's too late. This is happening right now. The LBMA withdrawals, the COMEX inventory decline, the central bank buying, the premium expansion, the delivery delays. These aren't random events. They're all pieces of the same puzzle, and that puzzle is showing us that the gold market is fundamentally changing. The era of paper dominance is ending. The era of physical scarcity is beginning. And if you understand that, if you really grasp what that means, then you know exactly what you need to do. The most important move for gold owners isn't complicated. It's not some sophisticated trading strategy or complex financial instrument. It's the oldest, simplest move in the book. Own the real thing. Hold it where you can control it, and wait for the world to catch up to what you already know. That's the move. That's what's happening right now. And that's why this moment right here, right now, is so critical. Because the window is open, but it won't be for long. King.